We're gonna change the raffle today. We decided whoever's name tag stays on last gets the prize instead of the business cards. I just want to echo Father Hanwell and thanking Matt Terry and his team for organizing this breakfast and this view for us this morning. Also, Larry Carroll, Dylan Collins, and of course Father Hanwell from Fairfield Prep for having me. So good morning to you all. So back in September when Larry and Dylan asked me to speak, I was a little overwhelmed. Of course I was honored. And then when I sort of came back to reality, my next thought was to ask, well, who said no before you got to me? But seriously, I am honored to be here. My eldest son, Stephen, just graduated prep in May, and hopefully my other son will be starting in September, Larry. While I never had the honor of attending Fairfield Prep, I did get to live vicariously through my son, and I'm excited for the experience that I hope my younger son is about to have. I've seen from my biography, I've been on Wall Street for just about 25 years. I spent all that time on the buy side. And what the buy side is essentially the people who buy research and sales trading from people who provide it and sell it to you, and obviously they're called the sell side. I've been in the hedge fund business since 1995. The hedge fund industry really got its start probably, I'd say, in the mid-70s, but became very popular in the early 2000s is when we really became prevalent and known. Up until then, it was sort of a secretive society, but I've witnessed significant changes in the industry across my last 20 years or so. I'll touch on some of those changes, and I'll provide a humble outlook for where I think the hedge fund industry is heading in the future. Additionally, I'll talk about what I'm involved in now, and that's investing across state boundaries. Afterwards, I'll be happy to take any questions you guys have on the states, hedge funds, SAC. I'm here for anything you guys want to ask. So back in '95, the hedge fund industry had a little less than $200 billion in total assets. Now it's over $2.7 trillion, and it's growing rapidly. What was once a rather secretive environment is now dominated by institutions offering a suite of hedged investment options. Corporate raiders are now activists who are intent on consensus building or crowdfunding to present their case, or any shot on CNBC they get to talk about why they want to break up a company. Long-short equity, which is the bread and butter of the hedge fund industry, is categorized into multiple baskets. One of those baskets is called long-only, go figure. I used to use the phone to complete a transaction, and now it's an electronic algorithm in Jersey managing my executions. Eighth-point spreads are now penny spreads or less, which means for day traders, the cost of being wrong is less, but electronic volumes have gone through the roof. It means the traditional auction market, which has its roots back hundreds of years, is almost extinct. Sadly, someday we'll all be visiting the New York Stock Exchange Museum to see how business was so inefficiently transacted back in the old days. Hopefully they'll still be serving meatloaf sandwiches and playing Wait Till the Sun Shines Nelly in the background. Hedge funds today are found in many shapes and sizes. Most of them I can't figure out what they do, but involve some computer program that identifies mismatches and spreads faster than the other guys. These are complex strategies whose faults usually identify themselves once it's too late. I don't think many people realized what a mortgage tranche was, or a CDO, or a CDS, until the March of 2008, when the Great Bear Stearns was sold to JP Morgan for $10 a share on a Sunday night right before the Japanese market opened. And in case we forgot what they were, we were reminded in September of that year when Lehman Brothers went bankrupt. I think it was that moment in time where people really first started to question their investments in hedge funds. This included hedge fund allocators as well. It was a period where investors found their investments actually were not hedged. In fact, in a lot of cases, hedge funds were no more than levered S&P 500 proxies, which were masked to be protective instruments. For the record, my fund was down 4% from September 2008 until March 2009, and all my investors were made whole by April of 2009. The S&P was down 38% over that period. At that time, the level of performance was significant. However popular and consensus opinion morphed into, as long as I was losing as much money or I was losing a little bit less money than everybody else, I'm still doing a really good job. As an aside, it still bothers me that people made bonuses in 2008 because they lost less than the S&P, and that's how they got paid. After all, Everybody lost money. However, in my opinion, I think the prevailing attitude amongst allocators is still, as long as I do my job and lose as much or make as much as everybody else, I'm safe. I think there's a very low tolerance for risk in hedge fund investing right now, and I don't think that's why we were all created. I bring up that period in time because it was the beginning of the change of views in hedge funds. Since that time, most have underperformed a simple long investment in the S&P 500. There's a tremendous pressure on fees, and organizational costs are through the roof. In 1996, Seth Tobias and I started Circle T Partners with $3.8 million under management and about $50,000 in organizational costs. In 5 years, we grew that to over $500 million with several investment funds under management. In the 1990s, that was regarded as a large hedge fund. Currently, to start a hedge fund, you need about $200 million in assets to support a required infrastructure and a team, and about $250,000 cash up front to pay off legal and administrative fees. Job titles that have become requirements today are Chief Risk Officer, Chief Compliance Officer, Chief Legal Counsel, Chief Investment Officer, Chief Technology Officer, Chief Financial Officer, and finally, last but not least, at least I think not least, Portfolio Manager and Research Analysts. You can see how the costs start up to add a firm. I haven't even started to talk about the added infrastructure and redundant systems cost. That period really gave time to the growth of large asset managers, really because allocators were scared and they had every right to be. Up until 2008, we would call what I would call, and for anybody who's political, the Nancy Pelosi investment environment. You didn't know what you were invested in until you actually invested in it. Diversification plus scale equals safer. Additionally to their credit, they have been able to execute differently, better. Nowadays, hedge fund is kind of a dirty term. It's sort of like Republican. Plus, it's much cooler to say ideal and alternatives. What's an alternative? Well, essentially, an alternative is a hedge fund. Hedge funds are traditionally equity, debt, convertibles, credit, and any one of several arbitrage strategies. It's been brought in to include real estate, hard assets, private equity, and infrastructure. Basically, anything that isn't yet categorized. Alternatives are expected to become a much larger part of allocators' portfolios in the future, especially given the move in equities over the last 5 years. It's not that equities are expensive, it's just that with the end of QE3, it's probably a good time to diversify away as inflation comes back into the picture and volatility returns to the stock market. The future of alternatives lies in the hands of the mega-cap multi-asset manager. It's one stop for portfolio diversification. McKinsey & Company put out a report which indicated that 30% of public defined pension plans, endowments, insurance, and corporate defined pension plans all expect to increase their alternative investments over the next 2 years. I suspect that number would be larger. In my opinion, the future of alternatives is bright. As investors seek higher returns, allocators at all levels will have to find new ways to diversify beyond traditional stock and bond markets. Conventional wisdom is that fees are high and large allocators won't pay them. Looking at it a different way, if the return is sufficient, the fee structure becomes irrelevant. Think of them as the mutual funds of the future. There'll always be room for the startup. There is always plenty of money allocated to this space. Typically, a new fund's returns are always highest in their first 2 years of business. When I started Kenbelle Capital Advisors, so you said it right, back in 2006, from the day I left SAC to the time I started trading was about 50 days. That process nowadays is impossible. The allocation process has also become a lot more institutionalized. The average lead time for an investment is usually 3 to 6 months. There are endless levels of due diligence and mountains of questionnaires. All that is a function of the hedge fund's inability to hedge when things got rough. To sum up, the entire industry has gotten a lot more complicated and slower moving. Definitely a lot more institutionalized, but if that saves investors money, I guess that's a good thing. So back to the United States and the stuff that we're doing now in our fund. The US right now is beginning one of those transformational moments that we see every sort of 60 years or so. So let's sort of go back in time. Let's look from the period of, say, 1750 to 1850. There was a period of advancement in agriculture, manufacturing, mining, and transportation. It was primarily driven from migration from England to the Mid-Atlantic and the New England states. The next period we'll look at is from 1860 to 1920, where we saw a large ramp up in steel production, railroads, chemicals, petroleum, and electricity, and the early workings of mass production. This time period opened up settlements in the west and southwest as a railroad to steam technology allowed us to push to the coast of California. After that, from the periods of 1920 to 1980, which where the U.S. showed a massive ramp of manufacturing capabilities. it gave rise to cities like Detroit and Cleveland as iconic manufacturing cities. Lastly, I'd like to discuss the housing revolution. I believe it overlapped with the manufacturing revolution from a mindset perspective. The prevailing wisdom is that the housing bubble and leverage revolution started in the mid-90s with home ownership legislative changes instituted by Barney Frank, but the seeds were really sown in the early 1950s with the advent of the Levittown-type houses. Either way, the U.S. boom, the last U.S. boom, was the shortest, lasting from 1994 until 2008. Real estate assets inflated, cash-out refis, and securitization all led to the housing bubble. Growth areas during this period were primarily the coastal areas of the United States, the Southeast, and the Southwest. So what's next? What's the next big wave in the United States? Well, in our fund, we believe there's a massive economic boom going on in the U.S. right now. If you can invest in the companies that are levered to it. If you look at the average GDP growth from 2009 to 2013, it becomes very clear. Let's take a subset of a sector of Texas, South Dakota, Montana, Utah, Kansas, Oregon, and Washington. You're averaging 3% annualized GDP growth through that time period. Compare that to New York, New Jersey, Connecticut, California, and Massachusetts, which averaged 1.44% GDP growth. Clearly, this is because of the goal of the drive towards America's goal of energy independence and the shale revolution. However, this is only the engine that starts the trend. The offshoot is highways and roads, bridges, housing, schools, energy, and infrastructure. Because of the clean slate that is offered to these areas, they offer attractive tax profiles relative to the coastal areas. Housing is also significantly lower. Let's look at that same sample set. The states we looked at earlier, the states we used to call flyover states, the average home price today is $332,329 versus our coastal subset at $612,000. Of the states in our sample set, Texas, Washington, Wyoming, and South Dakota have no state income tax. Our coastal sample set has an average of 8.5% state income tax. As an aside, Wyoming just published that they had a $15 billion budget surplus right now. Another argument is that once the oil dries up, the growth stops and these areas turn into ghost towns. Well, for starters, there's roughly 100 years of proven and unproven reserves in the United States. Secondly, and probably more telling, major technology companies are making moves as well. Google and Facebook are building major data centers in Des Moines, Iowa. Google has a trading center in Ann Arbor, Michigan. Boeing is expanding its South Carolina presence. And look at the migration of auto manufacturing to Tennessee and Alabama. Add all this up, and it's a significant opportunity for regional banks, cement companies, and niche industries like welding companies. I was just talking earlier, as an aside, a good welder right now in the United States can make upward of $200,000 a year. Take that, college fund. As other industries participating are trucking, rail, and construction. You know, it's interesting, I read in a Bloomberg article on Monday that was talking about Warren Buffett and his investment in the Burlington Northern Railroad. He did this 5 years ago. He's paid himself back, well, he paid $26 billion for it. He paid himself back $15 billion so far, and within the next 2 years, he's supposed to get all of his capital back from that investment. And that's just a function of the growth that they're seeing, whether it's they're pushing coal, or they're pushing frac sand, or they're pushing autos. Production's been high, but there is some real growth going on as you sort of squeeze into the interior of the country. All the industries that I did mention are growing at mid-teens rates. So while the stock market's done well over the last 5 years, dig a little deeper, you'll find significant growth opportunities, sustainable growth opportunities within the United States. When I look back at the last 25 years, I can't believe how lucky I've been in this business. Nowadays, there's been many jobs lost to the computer. The New York Stock Exchange, I think, is the most glaring example of that. I do believe there'll be a role always for active portfolio management, but although I do think the last 5 years of low volatility has lulled us into the belief that the Fed will always have our back, and if things get rough, QE4 is right around the corner. The economic data recently has been the most positive to me that I've seen in 5 years. By real and positive, I believe it's the one thing that this recovery has lacked, and we're starting to see actual sales growth out of companies again, as opposed to cost cutting and rationalizations that we've seen to drive earnings growth in the last 5 years. This will lead to higher rates, which will lead to volatility in the stock market, but will also allow the country to get on a more normalized, again, real growth path. The areas that are struggling will continue to struggle as they're in need of structural change. but businesses will, on the whole, do better. The biggest catalyst, I think, that could be coming to the economy, and it's been talked about more in the last couple of weeks than I've seen really in years, is if we had some sort of low tax repatriation bill of cash held overseas brought back into the United States for capital investment only. I'm not about to handicap this happening, but like I said, it's a much more likely scenario in the past. So let's all keep our fingers crossed that happens. I know a couple companies are talking about it and they're pushing for the legislation, but my suspicion is that it won't come through until some point next year. A more normalized environment will allow for healthy diversification amongst asset classes, paper and hard, increasing the velocity of money, all things good, all need to be allocated by living and breathing investment professionals. So be on the lookout for a return to normal volatility in your portfolios. But remember, it's a good thing. America is getting better. So back to me being lucky. I guess the biggest lesson I've learned on Wall Street, someone said to me, Wall Street is like walking up a flight of stairs. You need to always be walking up that flight of stairs, and once you start walking back down, it's almost impossible to go back up. I found the best way to continue in this business is to have mutual respect for your peers no matter what their job is. We're all in this together. So I grew up in Queens, and my sisters and I were the only kids on the block to go to college. I got my first job on Wall Street working for a man who founded the earnings momentum theory of investing. He gave me that job because I thought I was a nice kid and I scored well on his math test. However, he was most impressed with the fact that I was commuting an hour and a half each way to go to school, working full-time, and going back to school. Now, I was lucky my parents did pay for college. My crazy life was my choice. But he said to me one day, and the reason why he hired me was he liked the path that I choose to find that job. Right, I'm a City University of New York kid. I beat out an Ivy League kid for the job, not because I was smarter. I mean, anybody here will attest to that, who knows me. But he was simply more impressed with my path. At one point, our mutual fund return surpassed that of the famed Peter Lynch, portfolio manager of the Fidelity Magellan Fund. I remember that day clearly. After calculating the portfolio in his head, like he did every day, he put his pen down, took his glasses off, and caught the 4:40 train back to Scarsdale to have dinner with his wife, like he did every night. Be humble. Like I said earlier, computers have replaced a lot of my friends. Some are doing things, some unfortunately still aren't. So in this business, with all its ruthlessness, to be successful, just be compassionate, humble, and respectful. I guess at the end of it, the best way to continue to be walking up that flight of stairs, and really the flight of stairs of life, in my personal opinion, I'm reminded of the principles that make Fairfield Prep a great place. Principles that I know my son and his newly graduated brothers have all learned. Learn something new every day and respect all, as we do not know the path they traveled. And of course, all we need at the end is our faith, our families, and our friends. Ad majorem de gloriam. Thank you. I'll take any questions you guys have.